Okay. Joseph Wang, thank you for joining me on the Magic Internet Money podcast. Um, where are you coming from?
Great to be here, Brad. So I'm usually in Las Vegas. I'm doing a bit traveling right now, so I'm not home, but I'm based in Las Vegas.
Okay, cool. Um, Before we dive into like the meat of everything, I just wanted to recommend people check your book out, Central Banking 101. I've been going through it. I mean, it's these concepts are so confusing for new folks, but the way that you write and the way that I've watched you on podcasts when you're talking to folks like George Gammon and others, it's helpful to have somebody like speak this stuff in a way that isn't super confusing. And yeah, I just wanted to say thanks for writing the book and being a resource for people to learn about how this stuff actually works because it's so complicated.
I totally understand, and that's why I wrote it. Not too long ago, I was in the shoes of you and I think many of your audience, and I was trying to figure out how everything worked. Now I had an opportunity to work at the Fed for a while, so that really gave me an opportunity to actually figure out how the financial system works. And so I took a chance, took some time, and wrote it down. Hopefully, it'll help others as well.
So, what did you do before you went to work at the Federal Reserve?
I've actually worked in a number of fields in my life. I started out my career as a lawyer, so I worked in a law firm for a few years, but I didn't find it to be very satisfying. I wanted to work in something that was more macro. If you work in a law firm, what you're ultimately doing is you're just chasing commas. You're like a very fancy secretary doing paperwork. I wanted to think about ideas, concepts. I wanted to understand how the world worked. And for me, that was looking at markets. That's what was fascinating to me at the time. It was hard to make that transition. I had to go indirectly. Ultimately, I went to a credit analyst shop. I was there for a bit as well. Credit analysis, it's closer to the market, but not quite there. Eventually, I made it to the trading desk of the Fed, where you are actually at one of the centers of the financial system. If when something goes wrong, it's the Fed that saves the day, and that's the particular part of the Fed that actually engages the market. So when you're talking about quantitative easing, when you're talking about, let's say, massive repo loans or FX swaps, that's done by the open markets desk. You get a huge inside view of how everything works, and it was a phenomenal learning opportunity.
Oh, yeah, that's awesome. Like what years was it that you were doing your university for becoming a lawyer?
So I was class of '08 at Columbia Law, so that's been out for a while.
So you were class of '08, and then were you trying to get into finance right away, like during the 2008
Yeah,
crisis?
that was not the best time to be going into finance, right? So, I had the bad luck of graduating into the great financial crises, and the labor market then was very, very poor. So, um, if you wanted to move into finance, that was definitely the worst time. One, the entire industry was shrinking; it just gone through a terrible crisis, and two, there's a whole bunch of laid offs, bankers and traders, investment analysts looking for jobs. So it really was impossible to make that transition. What I ended up doing was going back to school. I got a master's in financial economics, and then moved slowly towards more market-oriented roles. I found out in life that sometimes you have where where you are, you know where you want to go, but you can't actually make that direct leap. Sometimes it takes a few years. Sometimes you have to go a longer way, and that's how it was for me. In between law and actually working as a credit analyst, I was actually in an economic consultancy as well. But gradually you build relevant skill sets and you make the move closer. So I think a lot of people are in that situation. So if you have a goal, if you want to be somewhere else and you other than where you want to be, sometimes it takes time, but if you keep at it, you can make that transition.
And what's your kind of a non sequitur, but like what's your goal in these days? You've got this book out; it's doing really well in circles where it matters. What's your next goal? What are you hoping for in the next like 5 years or so?
Yeah, awesome. So I actually don't really know. Um, s- what's awesome is that I've been traveling a lot this whole year, and thing is, most of my income comes from the market. I write blogs and so forth, but mostly it's to help people and uh, to build up a reputation for myself. So um, I've just I write about the wealth effect, and I'm sure many people in the Bitcoin community feel that as well. And so, I've just done really well in the market for the past few years. So just have the opportunity to take some time off, think about what I want to do, and I'm not quite sure yet.
Cool. Well, you think like maybe you'd want to like start your own fund or something like that, or more so kind of like do research a research shop or something, or maybe become a movie director, or where are you going?
Yeah, honestly, I don't
See
know.
what
So
happens.
yeah, I'm going to see what happens. A lot of things are changing in the world right now, right? So
Oh yeah.
I'll see where the opportunities are and see where things take me. One of the things I've noticed is that like yourself, when you have a Twitter presence on social media, you get to meet people, you get to learn things, and so it's been a really interesting experience, and it opens up, I think, some possibilities.
When you were trying to get a job in the credit or financial system, whatever, I forget what it's called, credit analyst. Were you paying attention to things like Occupy Wall Street and like Peter Schiff talking about gold and things like that around that time? Because that around that time it was you graduated right when like Ron Paul was running for president, and there was a end the Fed movement, and there was a lot of this energy towards placing the blame on Wall Street and the central bank for doing bailouts. What was your thoughts around that time about the bailouts and the Fed and things like that?
So I was in Manhattan all that time. So I
Oh,
I
really?
actually so post to the I spent about 12 years in Manhattan. So I was there. I visited Zuccotti Park. I saw the Wall
Wow.
Street Occupy Wall Street encampments. I was actually it was if you look at it on TV, it looked huge, but Zuccotti Square, it's actually a pretty small place. So it was not very representative of what they were portraying on TV. Um, I I looked at all that stuff that we're talking about the Fed and everything. I didn't really understand it very well, and that's part of what prompted me to study more about it. I actually think what the Fed did back then was the right thing. I think the point is that if the Fed did not, let's say, provide the support to the financial system and the banking system that it did then we would all kind of be living in caves. I think things would be much, much worse. If you think back of what happened during the Great Depression, the part of that is because the Fed at the time did not step in. They just kind of, yeah, there's a lot of banks going out of business, nothing we can do, and so a lot of people lost everything. That did not happen this time, and that's because the Fed stepped in.
So back then, like the arguments didn't really resonate with you, that people were like, "Oh, it's unfair that these corporations and banks are getting bailed out when they should just fail," um, versus the practical kind of like, um, if they didn't step in and bail out these companies and banks, then we would be in a depression, and that would be worse for people. Like back then, what do you think it is about you that made it so that you weren't like anti-authoritarian type of reaction like most of us had towards the bank bailouts and stuff?
So we tried that. We tried not being that out in the 1930s, right? So what happened then was that there was a tremendous run on a bunch of banks in the U.S. And well, when you have a bank run and the bank couldn't, so a lot of people are withdrawing money from the banking system. Banks couldn't make that, and so the bank went under. And so people who had deposits there, they lost everything. And companies who needed financing, they could not get it, so they were gone as well. So what happens when people lose their savings they had in the bank? Well, they kind of go on the streets. What happens to companies that go under? Well, they fire their employees. And that contributed significantly to the Great Depression that we saw in the 1930s, right? So that's what would have happened if the Fed did not come in and just save the financial system. That doesn't seem like would be a good idea, right? To have another depression. Sure, I understand that a lot of the people who benefited from the run up into the GFC, the bankers, so forth, they made a lot of money, and at the end of the day, they didn't have to pay. They didn't pay the social price for it. But the alternative is that everyone else would be worse off. So I think it was the right decision for the Fed to
Right.
step in and save.
So if you're saying like if you had to choose between these two paths, save from a depression or let the depression happen, then obviously the right decision to sort of reduce human suffering would be to save the system even though maybe the system isn't fair or maybe the system is a little rigged. It's better than the alternative.
Yeah, so absolutely, absolutely. I mean, I think that's an easy call, really. It wasn't. I don't think it was a hard call. What's more interesting is whether or not it was right to save Lehman, right? So if you actually saved Lehman at the time, I mean, Fed probably would have to do less than what it ended up doing. Um, so I understand the moral outrage, but all the people who are complaining about it, I'm pretty sure they would have been much worse off if the Fed did nothing.
Were you like a student of monetary history before you got into this? Like at that time, 2008 or so, had you been studying like the depression and previous cycles and markets and stuff like that? Or was it kind of like you're learning as you go sort of thing?
Learning as I go. Back then, I didn't really know anything else. I was a lawyer, and most of my classmates in law school could barely do any math, right? So,
So did you
so
did you get that perspective of it's kind of like Keynesian, I guess, if you want to say that, the Keynesian perspective um, versus the Austrian sort of sound money perspective, which it seems like a lot of people that know how the financial system works and work in the financial system, they're more fans of Keynesian or monetarist or whatever types of money systems versus the sound money systems, and mostly is because of that they believe if you operate on a sound money system, then when the crisis happens, like a depression will follow, and you won't be able to expand credit enough to get you continuous growth and things like that. Do you have any kind of like objections to sound money itself, or just you think that this is a better system um, for an
what
economy?
what do you mean when you say sound money? When I hear that, it means very different things depending on who's saying it.
So I would say that a monetary system where the central bank doesn't interfere with the market and set rates, where the central banks and the commercial banks are more restricted on creating money, and the risk reward equation is a lot more prevalent, instead of having the central bank come and step in and socialize the risks. Just allow a lot of failures in the system because the money supply can't be created and manipulated with under a sound money standard.
Well, I would actually, well, I think it's important to understand that it's not just the central bank that creates money, but most of the money in the system is created by the commercial banks when they make a loan. And this was true even when we were under the gold standard. So um, I think that I think it's a good point to note that when you have a very government involved in the money in the financial system the way it is now, it creates lots of distortions, and we didn't have that 100 years ago. Um, it's really hard to say if that is better or worse to have this level of involvement. I think it really depends on who's managing the system. If you have someone who is, uh, I guess, good people managing it, you can have a better outcome. But what happens usually is that, you know, people get co-opted by special interests such that things end up the game ends up being rigged, so to speak. And so, for example, if you are friends with the people who have a lot of power, then maybe you could benefit from that. And so, at a high level, it seems like a sound money system is one that has less government interference. Is that right?
Yeah, I mean, it would be a system where the banks do not have the ability to create as much of the money supply. I suppose it would be more like you can kind of have it, to go back to the private money system, I guess, where the lawful legal money would be a sound money asset that can't be inflated at will, but the banks could create their own money just under more strict regulations.
So I think if you think back a few hundred years ago when let's say money was gold and silver, you would have these episodes, let's say when the Spanish set off to the New World, found a whole bunch of silver, imported it back, and poof, you have tremendous amounts of inflation throughout Europe. So then, there are downsides to having that kind of commodity standard as well, because, well, sometimes you get a windfall, you find a new gold mine, and that that's has nothing to do with the rest of the economy. Just someone got lucky, right? So
Yeah,
if you have a commodity standard, there are downsides as well. Whereas if you had like a a Fed-based standard, that's not going to happen. You have other risks, of course. You'd have a government that just goes and spends money without limit, as it does now, and that's inflationary. Um, I think, though, that the underlying problem isn't what money is based on, whether it's gold or silver or anything else. It's really about the people running the system. When we had a gold standard, we still debased, right? Still got off of it. It's because the people who controlled the system
right,
were using it to their own advantage. So to me, it's not so much about what's the basis of money as it is who's running it, and there's
right.
always someone running it. You just have to have the right checks and balances to make sure that they don't abuse it in a sense. And I think we're losing those checks and balances.
Yeah, no, that's a fair point. And I'm not a hard money kind of like gold guy or anything like that. I when I was first learning about money and around that time, 2007, 2008, I was young. I was a young entrepreneur. I was making some money with a online business, making games, making virtual currency for video games on Facebook. And I started having this extra money, and don't have a background in finance or law or business or anything like that. I was more like a bootstrapping entrepreneur, and I had this extra money now, and I'm thinking, okay, well, the housing market is a little bit high. I don't really, I guess I'll build a house, but rest of my savings, the system just seems like so overinflated. I don't want to have my money sit in cash. So I started learning about money, and I was going down the rabbit hole of sound money versus Keynesian. The gold has been money through thousands of years, and the value of having a scarce monetary asset versus something that can be the money supply inflated at will. And during that time, I kind of went down, I think, the gold bug rabbit hole of what money is, which it turns out, it appears that that fractional reserve banking paradigm is a myth. The consensus that I'm sort of coming to from reading your book and listening to other folks on financial podcasts, and talking to Francis Coppola and folks that really know a lot about how the banking system works, is that this system of fractional reserve banking, where there's a money multiplier effect, where when you deposit money, the bank creates new money from thin air based on your deposits. And apparently, like, that's not how it works. That the system doesn't operate on a fractional reserve paradigm. In fact, it's actually like a zero reserve banking system, where banks can create money, because in their modern banking system, money is credit. So why do you think it took from 2008, 2007, when the kind of narrative that was getting put out there was that we were under a fractional reserve banking system, and not just by like alternative sources like Peter Schiff and folks like that, but economists would talk about the fractional reserve banking system and the money multiplier, and it was presented as if that was the reality of the banking system that we lived in, that we had this fractional reserve system. Why do you think it took until 2020 before we started to sort of correct the record and have this consensus that we don't operate on fractional reserve? We actually operate on this zero reserve credit system.
It blows my mind that there's such poor information on this subject. If you go to an economic textbook, you can still find people talking about the money multiplier. And then, to be honest, when I was working at the Fed, I was talking to people who are relatively senior, and they seem to, talk about the money multiplier too. There's a lot of confusion in this set, I think, in the field of economics. So it's not money. The understanding of money in banking isn't taught very well. Professor Richard Werner, for example, he's been on a crusade for like I say, the past 10 years trying to teach people about this. And so now, as you've mentioned, the central banking community seems to have a better understanding, a better consensus. There's always been people who understood this, but they just didn't spread it as well. So you have the Bank of England, for example, coming out with that pamphlet, Money Creation in the Modern Economy. And now you have people like yourself, Brad, who are there teaching people about how the system really works. It's strange that it took this long, and I just think that it really reflects very poorly on economics as a profession. But maybe it's not a surprise to if you look at the track record of at least macroeconomics, it's not very good. You have to wonder if it's actually a real field and if the people who are experts actually know something that you
Good
don't,
point.
right?
Do you
So
think maybe
one
it was
one
do you
thing I'll
think
add,
okay, go ahead.
just broadly speaking, since um, I think people might not be familiar with this, is that the way that, let's say, a field like academic field works is a lot of it has to do with politics, right? So you have a big professor, he has tenure, he has control over, who he admits to this tenure circle, and he knows the people who are in the publication game and so forth. So these people have disproportionate influence as to what things are. So it's not so much a pursuit of truth, as we would like it to be, because in a field like economics, it's not like physics, right? There's no absolute truth. It's a whole bunch of, equations and hopes and stuff like that that doesn't work very well. So in a fuzzy field like this, a lot of it comes down to politics, and you can have people who just don't know what they're saying or say things that are absolutely wrong become very prominent and kind of control what everyone else learns. So the closer you are to the physical sciences, to objective truth, the more effective academia is. The farther you are, the more political it becomes.
And I suppose it is kind of a consensus thing where some people still argue that, yeah, we have fractional reserve banking. It's just that, they put the reserve to zero. So it's just a zero reserve or whatever. It does seem like the consensus, though, is going more towards fractional reserve banking doesn't exist. It hasn't for a while. But
No,
when did fractional reserve banking exist? Was it before 1971 that we kind of like
so
before the gold window was closed? Was that when fractional reserve banking was more
okay,
prominent?
so I would actually frame it a bit differently. So there's a common story about how modern banking began, and that's with the goldsmith bankers, right? So once upon a time, everyone used gold as money. Okay, so if you had money, it was gold. But the thing is, you don't want to put gold in your in your house, right? It might get stolen. So you wanted to put it somewhere safe. Where is somewhere safe? It's the local goldsmith. Local goldsmith deals in gold, has a huge vault. So you would take your gold pieces and you deposit it at your local goldsmith. And as proof that you actually uh, deposited in the vault, the goldsmith gives you a certificate. Okay, so whenever you want your gold, you take your certificate and you give it to the goldsmith. Now, let's say you're Farmer John, you want to go buy a cow from Farmer Smith. Okay, you take your certificate, you go to the goldsmith, get your gold pieces, walk it to Farmer Smith, give him the gold pieces. Farmer Smith gives you the cow, and then he takes the gold pieces and then just goes in and deposits it into the goldsmith and gets a certificate back. Deposits the goldsmith, gets a certificate back. You do this long enough and you realize, hey, this is kind of a waste of my time, right? Why am I exchanging gold pieces? I should just exchange a certificate outright, right? We know that the goldsmith is a good person. So instead of going to exchange your certificate for actual gold pieces, next time Farmer John goes to buy a cow from Farmer Smith, just gives him a gold certificate issued by the goldsmith, and then the Farmer Smith is happy with that. Um, that's the story. Okay, then the goldsmith sits back and he realizes, let's say I have 100 gold pieces in my vault, 100 gold certificates outstanding. But wait, very, very seldom do people come and actually ask for their gold back. So that means that I could issue more certificates than I have gold in the vault. And you know what? No one, as long as not everyone comes and asks for the gold at the same time, I I will be okay. So I can start making loans. Let's say I lend the cobbler, let's a gold certificate, right? So I have a 101 certificates outstanding, 100 gold pieces in my vault, but one gold piece loan. And so I began to be able to expand my balance sheet, create money out of nowhere, right? I can create more gold certificates. They're backed by loans now instead of the same amount of gold pieces. But as long as not everyone comes and asks for their gold back at the same time, I'm fine. And so you can think about it as, let's say I have 101 gold certificates outstanding, only 100 pieces of gold. That's fractional reserve banking, right? So the system is still fractional reserve, right? So if you're a bank and create loans and deposits, you create much more loans than you have money in the vault, right? So if everyone went to their bank and asked for the money in their checking account out, the bank would not be able to meet all those withdrawals. It only has so much cash in the vault. It's still fractional reserve. Reserve is not binding though, so it's not really the binding regulation now.
Right.
The reason is okay, well, I'm sure you know there is no reserve ratio anymore. It's been taken away.
I
There
was
are other
in the COVID crash, right, in the crisis 2020, they just reduced it, reduced all the reserve, not all, but, like, I think it was, what was the reserve that they put to 0? What was that technically called?
That's the reserve ratio.
The reserve ratio.
Yeah, so reserve ratio, for example, if you're a bank and if you have, like, say, people deposit $1,000 with you, you'd have to keep $10 in the vault. That's to make sure that, so not everyone is going to come and ask for their money back at the same time, but sometimes people will, just to make sure that you have enough money in the vault to handle those withdrawals. So that's what fractional
And
reserve banking is
that's
about.
the LCR, the liquidity coverage ratio, is that where
Yeah,
they have to have 30 days of expected
yeah,
outflows?
yeah. So that stuff, that supersedes the reserve ratio. That stuff is much more binding. So, um, like you mentioned, the LCR is to make sure a bank has enough liquid assets to cover 30 days of withdrawals. Um, so one, it's more dynamic because instead of just saying, oh, you have these deposits, you have to keep these reserves. Now it says you have to estimate, based on your own history, what kind of outflows, how many people come and withdraw money from your bank. It's so much more dynamic. And the second part is it's a lot more flexible in the assets that you hold. Instead of just holding, let's say, cash in the vaults or deposits at the Fed, you can also hold things like Treasury securities, which, are pretty liquid. So let's say, again, you have 1,000 deposits in the bank. Everyone comes and asks for it. Well, if you don't have enough cash in your vaults, maybe you could sell some treasuries and get some cash and use it to meet the withdrawals. So it's actually a much more stringent, so it's a higher standard than just this flat out reserve ratio.
Um, so I personally come from the perspective of I feel like the banks are still taking on too much risk. And my perspective watching the 2019 repo market, interest rate rise and the Federal Reserve come and step into that market, I was kind of expecting some kind of financial blow up to happen in 2019 because I was trying to figure out how the banking system worked, and I was reading about the Basel III Accords and seeing how, like, there was this, like, 10-year, or I think it was 8 years, 9 years, whatever it was, ramp up process for the stress tests that were all supposed to be put in place for the banks. They would slowly ramp up until 2019. They were 100% effect in 100% effect, and they had the reserve ratios. And I mean, for years we were being told that the banks are being stress tested and we're putting these stringent restrictions on them, and we're going to make sure that another collapse never happens because the banks are going to be more sound and they're going to have better balance sheets and everything. But then when the system got to 100% effect and they had to actually pass these stress tests and abide by these Basel III regulations, where they needed to have 8 to 12% reserve or whatever it was, it seems like the whole system blew up. And I felt like that, and a lot of us felt like that there was some toxic banks that actually couldn't meet the stress tests, and and that's why the repo market sort of went wild, because the repo market is where banks lend to each other with collateral, and it's an overnight lending. Typically, it's an overnight lending where you're lending from one bank to another bank, potentially to meet your reserve requirements. Because if you've got too much loans out and you don't have enough reserves, you can just borrow at a small rate in the repo market to temporarily meet your Basel III requirements, your stress test requirements. And if there was insolvent banks out there who couldn't pass the tests because of whatever, they've have too much risk, they have too much toxic stuff on their balance sheet, the banks would stop lending to each other, and the rates would go up because that would price in the risk of lending to a potentially insolvent bank, because you don't want to be trading with the next Lehman, or like somebody that's exposed to some like LTCM style thing or some Chinese debt or whatever. So there was a lot of us that kind of felt like that the spike in rates in the repo market and the Federal Reserve having to step in the repo market to do trillions, or 1 trillion, I think it was, over 9 months before COVID even happened, was actually more of a symptom of an over-leveraged, toxic banking system rather than what they were saying. I think was there was like some end of year tax obligations, which actually drew in base collateral, so that the banks were less likely to want to lend to each other because they had to meet these commitments for the end of the year tax system. I mean, are you familiar with that whole narrative around why the repo market blew up? And if so,
Yeah.
like, what do you think of the idea that some of us had that they couldn't meet the Basel III requirements, and that's why they dropped the reserve ratios to zero, reserve requirements to zero, because when they finally got into full effect, the whole system seemed to blow up.
So I worked a lot on that repo spike. So, when the repo market breaks like that, what happens is everyone calls the Fed. I was one of the first people on the open markets desk that day. I remember getting a call from a bank being like, "Hey, have you seen the repo market?" I'm like, "No, I have. I just got in." So I sat down and I took a look. So repo was, like 2.25%, like the last week. I looked at it and I was like, oh, 5%, that is a little bit above average. So I was staring at it, and suddenly like two more people called and five more people called, and the whole phones were ringing off the hook, because there was a lot of stress that day. Repo is supposed to be a very quiet market. If you're 2.25, let's say if you're 2.25, then you should be about 2.26, 2.24, just like that every day, not a big deal. You don't go from 2.25 to 5 to 7 to 8. That doesn't happen. That's significant stress in the market. So I would say that that's actually not because of the banking system, though. So what you said about the banking system was correct, but it's more accurate description of how the world worked pre-GFC. I think one thing we should keep in mind is that the system is always adapting, and we have a tendency of fighting the last war. Sorry. So, for example, during the GFC, say Fannie Mae and Freddie Mac are two huge organizations. They lent money to Lehman, right? I think $1 billion or something like that, and they basically lost a whole bunch of it. And from that day on, they never lent money unless they got collateral back. So that kind of burned them, right? So in the same way, when we think about the banking system, it crumpled in 2008, and there's a whole bunch of legislation and efforts, both in the US and globally, to try to fix it. And the end of that result was a banking system that, in my view, is quasi-socialized. It's extremely boring and extremely safe. That's part of the reason why you don't need reserve ratios anymore. They have so much liquidity, so much safe assets on their balance sheet. It's very, very difficult for a bank to ever have a liquidity problem. If you look at a big bank like JPM, it's a huge fraction of their balance sheet is cash-like assets. It's almost impossible for them to have a run or anything like that. So,
But is that because of the 2020 QE and repo market stuff?
so yeah, yeah,
That's
so
why
they
they've basically been recapitalized by the Fed and the Treasury, I guess
so
Congress.
so capital is a bit different from let's say liquidity. So capital is a liability. So for example, let's say you're an entrepreneur and you start a business, right? You put some money together, okay, and then you go and let's say you buy a let's say a car or something like that. Okay, let's say you bought a car. So your capital would be the stuff that it would be the equity that you put into the business. That's what you could lose if the business failed. The assets that you own would be the car. So when you're thinking about capital and you're thinking about liquidity, the capital would be the amount of let's say shareholder, like let's say if you're a stockholder, how much you invested into, let's say, JPM, and that if JPM failed, that's what you would lose. Uh, Liquidity is a bit different. It's how much it's like the car that you would own in the example I talked about. It's about how much cash JPM has at the Fed. So those are related concepts because one, um, If so if a JPM has a lot of losses, then that means the people who own JPM, the shareholders, they take that loss. So the capital holders take losses. And if you have a lot of capital, then you can take a lot of losses. And so even if you make a lot of bad loans, you won't go bust. So that's to prevent a solvency crisis. So prevent the bank from going under. Liquidity is a bit different. It's that if a lot of people, for example, ask for their money back at the same time, if you have a lot of cash and deposit at the Fed, that's less likely to happen because you can meet those withdrawals. Now, post GFC, there's been tremendous changes in both those metrics. Banks have to hold a lot of liquid assets. Like you mentioned, the LCR made it tremendous, almost impossible to have runs on banks. And also, as you suggested, it changed their capital structure. So banks now have to hold a lot more capital so they can absorb a lot more losses before going under. This makes the banking system much safer. An easy way to see that is to look at what happened in March 2020. Like if you look at the stock market or the bond market in March 2020, tremendous, tremendous stress. You have, let's say the Treasury market breaking, you have a lot of mutual funds, you have local, state, and local governments all having problems, and you have a lot of people having solvency issues as well. But where you did not have any problems was the US banking system. It was much, much more resilient than it was in the past. And I think that's this stress test shows everything. Now, moving back to what you were mentioning about the repo market. So in the post GFC world, the repo market is also different. So in the past, it would be, as you mentioned, banks would lend to each other a lot in the repo market. But post GFC and post QE, banks have a lot of cash on deposit at the Fed, right? That means you don't really need to borrow from anyone. So banks are actually lenders in the repo market, not borrowers. So when the repo
That's the
rates,
reverse repo market?
yes, exactly. Yeah. Um, I, that's not everyone knows that. So, but we'll just say repo since it's easier to understand. I'll just say repo lending instead of reverse repo.
Okay.
So banks are lenders in repo
And
markets.
did they lend to the Fed?
No, so they lend to the hedge funds.
To the hedge funds, okay. And
So the
they
hedge
earn a rate that's slightly above the Federal Reserve. What's that called? Where if
So,
you
so
park your
it's called interest on reserves.
IOR, interest on
Yeah,
reserve rate?
exactly. So what was special in 2019 is that the hedge funds had tremendous demand for repo financing, so much so that they were pushing repo rates that they were above interest on reserves. So you're a bank, you're sitting, you're watching this, you're like, hey, I could, reserves, I can earn, let's say 1%. So it wasn't 1%, but just for sake of argument, 1% at the Fed, or I could lend it out into repo market and get 1.1%. And from a regulation standpoint, lending in repo is the same as having cash at the Fed, because when you lend in repo, you get a treasury security as collateral. It's very safe. So, okay, you know what? Why don't I just lend a whole bunch of money into the repo market,
Wait,
get
can
that
we go
extra?
back a sec? I
Yep.
kind of got lost there. So when you lend into the repo market as a bank, you're lending your Federal Reserve bank reserve
Yep.
money,
Your
I guess, right?
deposits at the Fed.
Deposit
Yep.
the Federal Reserve, and you're getting back treasuries from your counterparty or from the Fed
Oh no, it's you're lending it to the hedge fund.
to
So
a hedge
so
fund.
yeah, so you're lending it to a hedge fund. You would get you would so I mean just it's not that important. So you would lend to a dealer who then lends to a hedge fund, and the collateral would move from the hedge fund to the dealer to the Fed. So a dealer is kind of like an
And is that is
intermediary,
that
it's like a
because
broker.
is that because the hedge fund cannot have an account at the Federal Reserve, but the dealer can? And so the dealer like basically gives them access to the reverse repo market through their account at the Federal Reserve?
So so the underlying plumbing about reserve accounts, that's something that's separate. Um, when the system works, you're what you have a deposit on the bank, it's all fungible. So the reason it goes through a dealer is because it's the dealer's job. A dealer's like a broker, right? So, like for example, if you have a Schwab account or something, the dealer has the relationships. It knows who
I
needs
see.
repo financing, and so it's the dealer's job to have a whole wide network of people like hedge funds and be like, hey, who needs money? So I'll get you money, and hedge fund knows the bank, knows the dealer knows the bank, and gets the money there. So it's not because of the reserve account thing. That's all, back office plumbing stuff
Okay.
that's in this instance not relevant. So you know, banks were lending in repo market. So if you're a lender in repo and rates spike, that doesn't hurt you. It hurts people who are borrowing in the repo
Hmm.
market. So it's not really a banking system issue. What happened is that the repo market was losing monies because of quantitative tightening. So the Fed was taking money out of the banking system.
In
Banks have to,
2019,
yes, quantitative tightening.
right? They tried to roll off the balance sheet, right? And then that's when the stock market crashed and the repo market blew up.
Stock market crashed, I think in 2018 and then
I
2020.
mean, it's the stock market. The stock market started to sell off. I
Yeah,
think it was in September 2019. I
I
feel like.
so I think the repo market was more impacted. That I can check. So okay, so yeah, so it was more the repo market. So what happened was that, again, tremendous demand for repo financing. Fed was taking money out of the banks, less money available for repo to lend in repo. Boom, you hit an air pocket. As things are, the markets are they work all really well most of the time, but then something happens and they break. We see this all the time, right? So that's what happened in the repo market, which is very surprising because, I mean, the repo market, it's super deep. There's $1 trillion in transactions every day. There's no market deeper than that. So for that to break, I think it was surprising to many people.
Let me ask you two specific things that kind of I always wondered about the repo market. I don't. This is a total noob question. I don't know if this is possible or not, but um, first of all, like the mechanic of the repo market, I started to read about the high quality liquid assets. That was one
Yep.
of the things I started to kind of dig into, where HQLA is this system of like gauging the quality of the collateral or the asset that you're going to post for collateral. And there's level 1, level 2, and level 2A and level 2B. And like level 1 assets are cash and cash like equivalents, where, that's money at the Fed or US Treasuries, things that can be easily exchanged for cash, and
Yep.
it's super deep in liquid markets. Level 2A, and those are 100%. They have 100% margin or whatever, effectiveness or whatever. I forget the word, but they're counted for 100% of their value. The 2A and the 2B, they have discounts. I think 2A has a 15% discount and 2B has a 50% discount. And 2B could be level 2B counts as even your bank's own stock or stock of a company you can use to post as high quality liquid assets in these markets where you're lending and borrowing, or to meet your reserve requirements, or sorry, LCR requirements and things like that.
Yep.
So to me, it was like, it felt like there was always this opportunity, this window for banks or counterparties or whatever in repo to use toxic insolvent stocks as part of their swapping with the Fed for level 1 assets. They could just use level 2B assets like their own bank stock, which could be not worth even 50% of its value, but they could loan it, or they could post it to take loans of base money at the Federal Reserve, um, in exchange for these level 2B assets, but they would just have a 50% discount applied to them based on the HQLA rules. I'm not saying that's, I mean, I think maybe that did happen, but can you tell me whether or not that's even possible for that to happen in the lending markets?
So in practice, what happens? The banks have to disclose what they hold in their HQLA portfolio. And first of all, I'm very impressed that you read into the level 1, level 2 stuff. That stuff is, it's very in the weeds. So, um,
That's why I'm so confused, because I've been getting into the weeds and I don't have the compass.
so the banks disclose what they hold in their HQLA portfolios, and in practice, it's all level 1 stuff. Okay, a little bit of level 2A, which are mortgage-backed securities. So agency mortgage-backed securities. So they hold a whole bunch of treasuries and agency securities that are backed by Fannie Mae and Freddie Mac, which means that they are credit risk free because they're backed by these government agencies. In practice, they don't really hold anything else. Nothing else. So actually, one thing you can think about is that if you're a big bank, you actually have a team of regulators that literally sit inside your office every day. Like, the Fed would have like a team of people who sit inside JPM, and their whole job is to see what JPM is doing. So
Right.
you
But
don't.
during crisis, though, like during the repo market crisis, where the Fed had to come in and just provide liquidity into the system, is it? I don't even know if this is the mechanic of how the repo market works. That's why I'm specifically asking this. I don't know if the repo market works on this HQLA thing where you can actually just swap a level 2B asset for a level 1 asset, and
You
it's
can.
just considered like this. It's fair game because it's part of HQLA. But is that how the repo market works? Is it based on HQLA or is it based on the asset? Like the
So
counterparty knows that they're getting this in exchange for this rather than you're just getting
oh, no, no,
HQLA
no, 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 no,
assets.
no. You absolutely know what you're getting. You can control that. That's
So
100%.
you could say, no, I don't want your bank stock even at the 50% discount. Even
Yes.
if it's qualified as level 2B, I don't want it because you may be insolvent and I don't want to take that collateral.
Absolutely. You have complete control as to what kind
Okay.
of collateral that you get. In practice, the repo market for stuff that's not HQLA is very small. And there are people who do, let's say they try to exchange their lower quality assets for high quality. It's called a collateral upgrade, but people do that. Um, but in practice, the repo market is mostly HQLA. It used to be pre-GFC. There used to be a whole lot of stuff that's not HQLA, but like I mentioned, there's this regime shift between pre-GFC and post-GFC, such that people don't really want to lend against riskier assets these days.
So, and then the second question regarding that, I've always wondered this. Because the repo market works, as I've been learning about this, I guess I've learned that there's uncollateralized overnight lending, which I think is the interbank lending market,
Yep, federal funds rate is what it's called.
and LIBOR in Europe.
LIBOR. Okay, so the federal fund. So when the Fed says that our target rate is the federal funds rate, that's what you mentioned. Overnight unsecured loan between two banks. Okay, LIBOR is a bit different. So LIBOR is also unsecured rate. So the difference between secured and unsecured is, repo is secured. You get collateral when you lend. Unsecured is you don't get any collateral. You just get a promise that you get paid back. So that's the difference. So LIBOR is an unsecured rate. In theory, it's an unsecured rate that a bank in London would have to pay to borrow money. In practice, it's just a reference rate. So if you're a private company that's not a bank, you will be borrowing based on LIBOR plus something, right? So that you just have a benchmark as to where interest rates are. In the past, what would happen is that in London, a whole bunch of banks would submit and saying, "Hey, I think that if I had to borrow for 1 week or 1 month or 3 months, this is what I'd have to pay." Everyone would submit that to the agency. The agency would, chop off the extremes and come up with a number and say, today, this is what the benchmark LIBOR would be. So that's how it started. It's
Okay.
yep.
Okay, so there's LIBOR, there's the federal funds rate. These are kind of like unsecured lending markets. Then there's the repo market, which is the collateralized overnight lending,
Yep.
which I think you describe in your book Central Banking 101 that most of the or more and more banks and hedge funds and stuff are using the collateralized markets post GFC. So in the repo market, typically it's banks lending to each other and just doing these quick overnight loans to pay pretty low interest to secure collateral for their lending or whatever, like
No, so
maybe a hedge fund borrows from the overnight repo market to borrows money to then go and buy treasuries and kind of like finance an arbitrage between the overnight lending market and the treasury yield. There's kind of a lot of ways that banks can use that overnight lending to make money or meet their reserves, right?
banks don't have any reserve problems, so they don't borrow in the money markets anymore. So they can lend in repo, as you
I
mentioned.
mean, I guess I'm talking pre 2020.
Oh, okay, no. Oh, okay.
Pre
You'd have to go.
2020.
You'd have to go pre GFC for the world to work that way.
Okay. But in the paradigm where the Federal Reserve actually had to step into the repo market when you were working there, and then the majority of the volume that was happening in the repo market was all the Fed. They were doing hundreds of billions of dollars a month, I think, at some point, and they did it up until July 2021, I think, when they introduced the standing repo facility, which is just a new paradigm of like, if ever there's a need to use um, to to uh, to use repo, we're just going to have this official continuous window that you can access. But at that point, the banks had been all this QE and stuff had happened, and all this repo swapping had happened, that they have so much money at the Federal Reserve, or so much in whatever you want to call that, base money or tokens or whatever at the Federal Reserve accounts, that they didn't really need to go into the repo market anymore, because they're actually have enough collateral now to lend themselves. They don't need to borrow.
I think it's really important to realize that, remember, the banks don't borrow in repo, they lend. The people who participate in the repo market are largely the, hedge funds borrow, dealers borrow, and lenders are the banks or the money market funds. So it's really important to
Oh,
realize.
okay. So you're saying that even like in, say, 2019, the participants in the repo market, the borrow side, were not banks borrowing from each other. It was mostly
It
hedge
hasn't
funds and.
it hasn't been the case since the GFC. So no, banks
Oh,
don't
okay.
borrow
So
in
that's why
repo.
you said it like 6 times already. A little bit, sometimes a
No,
little slow. They don't.
listen, it's a structural change. You talk to a lot of senior Fed officials, and they're like, they won't know this either because they're boomers and they live in the pre-GFC world.
So the reverse repo side then has, the paradigm has always been since 2008 up until 20, I mean even now, but has been that the banks, the commercial banks are the primary dealers.
Commercial banks, primary dealers are dealers. They're not banks.
Oh, so the commercial banks have always been the counterparty typically in the repo market to lend to people borrowing, like hedge funds.
If they participate in repo, it's to lend. Yes, they don't owe,
Okay.
like right now, for example, like interest on reserves, as you mentioned earlier, is much higher than the repo rate. So your bank, you're not going to be lending in repo. It doesn't make sense. Just leave my cash at the Fed and earn interest on reserves.
So
So it just
how do you know that in 2019 and before that these commercial banks weren't borrowing from other commercial banks in the overnight markets? Is it because you worked there and you saw the books and like
well,
you just know that?
so yeah, but I think if you didn't have that access, you could also look at publicly available filings to see that that just wasn't happening.
So who is it then typically? It's hedge funds, and who else would be accessing the repo market to borrow?
Okay, so two types of people. Hedge funds, predominantly two types, hedge funds and dealers. So, okay, so a hedge fund, I think it's easy to understand, right? So a hedge fund, it's an investor, does all sorts of things, right? So it needs to borrow money to put on its positions. So the way that a dealer works is, a dealer is kind of like a supermarket. So a dealer goes out and it buys treasury securities, just like a supermarket goes and buys canned food, and puts it on its shelves and sells it to people. So um, a supermarket would borrow money to buy a whole bunch of canned goods, put it on its shelf, and then sell it to local people, and then take that money and repay the loan, and keep some for himself. Dealers, the exact same thing. Goes out and buys treasury securities, buys corporate bonds, holds it in its inventory, sells it to its clients. The way that the dealer gets money is from the repo market. So let's say the US Treasury has an auction today, sells $100 billion in Treasury securities. Okay, the dealer buys those securities using a repo loan. Then it sells those securities to its clients at a slightly higher price than it paid, takes the money the proceeds from that sale, repays the repo loan. So that that's
Okay.
uh so that's how there's two main borrowers.
So there's nothing that restricts a commercial bank from borrowing in the repo market. It's just that in practice, they've been the counterparty to borrowers instead
Well,
of.
in practice, they have so much money from QE, right? They have, literally trillions of deposits sitting at the Fed. It doesn't make sense. Why would I be borrowing money when I have trillions of dollars sitting in the Fed?
Can could a bank like Deutsche Bank that's not a US bank borrow in the repo market from US
Abs-
banks?
so Deutsche Bank can definitely borrow in the repo market. And listen, Deutsche Bank is a primary dealer, so they're borrowing, hundreds of billions, okay, so tens, hundreds of billions of dollars in the repo market. So they can definitely do. It's part of their business. It's not a problem because
I think I was confused by this because I thought that Deutsche Bank was a commercial bank.
okay, very good point. So if a dealer it's a business model. It's like you have a license from the SEC. You can have an independent company who is a dealer, or you can have a commercial bank who has a dealer business. Okay, so
Oh, I see.
if you're a European bank, what you would often do is you would have a New York branch office in New York, and you would operate a US based dealer business out of that bank. If you are a
Okay.
domestic bank like JP Morgan, you would have a separate legal entity. It's called JP Morgan Securities, I think, which is not a bank but a dealer, and have them do their dealer stuff.
I see.
It's yeah. So it's not an important detail, but that's why. So
It's interesting though because these banks like the JP Morgan and JP Morgan Securities, even though one is a commercial bank, one is a primary dealer, like are they kind of the same thing or is there like a firewall there between them? Like how are they separated
so
so
they're
that
all
they're
so
not like so it's not
so
JP Morgan borrowing from itself in the repo market or something like
no,
that.
no, that happens as well. That happens. So Um, though they're separate businesses, and you'll have different sets of people running them. So the people who run the JP Morgan's Treasury desk are going to be different from the people who run the JP Morgan primary dealer. They are united in that they're both owned by a JP Morgan bank holding company. So if JP Morgan, the bank, wants to do repo, they're going to call up the dealer. Hey, uh, you know, uh, I want to lend you some money, and so the bank will lend to the dealer, and the dealer then will lend to a hedge fund. So
Okay.
they work together.
So, okay, back to the second question. In the repo market, when the Federal Reserve steps in, typically it's commercial banks and primary dealers, hedge funds, et cetera, lending to each other. The Federal Reserve is typically not involved in the repo market. But then in 2020 or in 2019, when the repo market rates shot up, the Fed had to come in and provide some confidence and liquidity into this market to prevent a lockup, like what happened in 2008 and what happened in 1998 when LTCM collapsed and almost locked up the whole banking system. The Fed stepped in, provided liquidity. It be not an overnight loan, but a 1 month loan or a 1 year loan, where you actually, because the Fed is your counterparty, you don't have to worry about that payment in the next morning, but you can actually have this loan kind of go on indefinitely. And was that happening when you were there, where the Fed was providing loans, overnight loans that were actually like indefinite loans or 1 year loans? Because I couldn't find any information on that. I searched and I
Yeah.
tried to find if that was happening. I could not find any information on that.
So that's a good structural point about how the repo market works. So the repo market, you could have, like you mentioned, one month repo, 1 week repo. You can't find. It's very hard to find one year repo, but the vast majority of repo is overnight. But that's okay because it's just rolled over every day. So if you are an investor, let's say you're a hedge fund and you get a repo loan, you know, you would just roll it over every day, every day. You like, if you want, you could probably get like a 3 week or a 1 month or so forth, but the vast majority of it's just roll over overnight. It's short term. That's just how the market is. There are risks. There are good things and bad things about it. If you're borrowing, borrowing overnight, you get a cheaper rate than borrowing for like a month. But if for whatever reason, you whoever's lending you money just stops lending you money, then you're in trouble. You have to go and find someone to borrow from very quickly. So I think that something to realize about the Fed involvement is that when the Fed lends, it's not lending to the commercial banks, it's lending to the primary dealers. So if there's a squeeze in repo market financing, what happens is that the Fed lends to the primary dealers, who then lend to, let's say, the hedge funds. So it's separate from the
Okay.
banking system.
I guess I was trying to suss out like a year and a half, 2 years ago when this was happening. Like, was it happening where the repo market was actually operating like a Fed bailout that wasn't authorized by Congress? Because if the Fed is your counterparty, isn't it just kind of optional to pay back the Fed if they're providing liquidity and saying that they're trying to rescue the banking system or whatever, and doing hundreds of billions of dollars with these banks and hedge funds in this market where they're lending all this money, basically no strings attached? Would it have been possible, or did it happen where the Federal Reserve lent money to kind of bail out these hedge funds and primary dealers with no strings attached, where they didn't have to pay the money back?
No, no. So if you do a repo loan, you got to get put up collateral, right? So fine, let's say you don't pay the Fed back. Well, the Fed has Treasury securities that's worth the same amount of money. So it's
That's where
not
the
a
level 2A, level 2B stuff came in for me, because I was like, if they were lending and the collateral that they were lending, taking from a hedge fund was
Oh, okay. So
like stocks, that was what was way overvalued, but they were treating it as a 50% HQLA,
I'll I'll
getting
I'll
back
I'll
treasury
I'll give you
securities.
some color about how this works. So there would be a haircut depending on your collateral quality. So for example, you are borrowing money from me in repo. If you give me Treasury securities, $100 worth, I'm only going to give you $98. Okay,
And you're
so
the Fed guy, right?
yes. So if you gave me something that was crappier, well, I'm going to need a bigger haircut, maybe 10%, maybe
I think
15.
50% is the haircut for level 2B stuff. But like, let's say you've got stocks in your
Yeah.
portfolio that are super overvalued, like they are way overvalued. You cannot sell those stocks to meet your collateral margin calls or whatever. Otherwise, you're going to start cascading, like kind of like or bonds, right? Like corporate bonds. There was this fallen angel thing that was going to happen in 2020, where as the bonds get sold down, their credit rating goes lower, and then that makes it so that regulated entities like retirement funds have to sell them if they become these fallen angel status bonds. So in the scenario where the whole system was at risk of contagion of a spiral, like a debt spiral, lowering its status and then creating more sell pressure, that's what was happening in 2020 when this system was kind of like teetering. So wouldn't it have made sense for the Federal Reserve to say, look, we'll take level 2A, level 2B assets off your balance sheet. We'll give you treasuries in the repo market. You can have more of like a secured, safe balance sheet. We'll take on this lower quality stuff, give you this haircut of 15 to 50%. But really, that removes sell pressure from the market, from corporate bonds and bank stocks and whatever stocks they may have been holding, and just swaps the collateral for like higher quality level 1 stuff. But
Well,
then, we would see that on the Fed's balance sheet, would we not, if that was
yeah,
happening?
well, the Fed did something even better. It just went out and bought corporate bonds. So that's
You're right, Ed. They just went and bought it. But do you think that was because that didn't happen until 2020 when the Congress got involved, but the Fed was doing this in 2019 before coronavirus and the pandemic even happened. They were
so
doing hundreds of billions of dollars of swapping in the repo market. So,
no, that was for cash for securities. It wasn't collateral
okay.
for collateral. So you're exactly right, though, that the Fed, I don't think was often mentioned. They bailed out the hedge funds. So the hedge funds, they're the people who are borrowing in repo. They're the ones that were like, oh shit, my interest rate is going to the moon. They were bailed out by the Fed. So what they were doing back then is something called a cash futures basis trade. So for example, let's say a 10-year treasury trades at, let's say, 1.5%, but the futures implies a different price. And so what you would do, and then let's say the futures implies a price that is lower. Okay, so higher than what the cash market is trading. Then what you would do is you would sell the futures, and then buy a cash treasury. And when the futures contract expires, you would deliver the cash treasury into the futures market, and you could make that spread. So that's what the
Okay.
hedge. Okay, so basically, you sell something. Say today is June. You sell something that's due that you have to do that's due in you enter a contract to sell something at the end of July, okay? But because you see something that's is overvalued, you know, let's say for example, the futures contract is trading for a hamburger at $10, but you can see right now that a hamburger is selling for $5. Okay, so I'll buy the hamburger now, enter in contract to sell it in June and July, end of July, and then poof, I bought something for $5 and I sold something for $10. I earned that $5 spread.
Right.
Okay, that's how it works. That's basically what the cash futures is. Here's the thing though, where do you get the $5 to buy the hamburger to begin with? You borrow it in the repo market. So the hedge funds sold treasuries forward and
Right.
bought treasuries, waiting to deliver that in the future to earn that spread. They were financing their treasuries in the repo market, except the repo market rates went much higher. Okay, that's a problem because then I'm not making money. What happens if I'm not making money? Well, then I don't want to do this trade anymore. I got to get out. So what happens if I get out? I'm going to sell a whole bunch of treasuries. It's very bad for treasury markets. So they don't want, Fed does not want all these hedge funds to just get blown out of their treasury market trades and blow up the treasury market. So that's why they went in and they bailed them out.
Right. So like they may have been making say like 4% or 3% on that arbitrage, but then when the
Oh,
repo market spiked up to 5-6%, all of a sudden these hedge funds are underwater in this trade. They're not making the
yes,
arbitrage spread anymore. So
yes.
they're either in trouble, like they have to come up with the money for the difference, or they have to get out of the trade and then cause
Yeah,
more sell pressure.
exactly. They have to put up more money to finance the trade because rewards are higher, or they have to just cancel it. And if they cancel it, that means I have to get out the treasury that I bought, right? So that's pressure, selling pressure
Okay.
on the treasury market. So
So you don't think that, I mean, there was any of the scenario where I described where the counterparties were swapping lower quality collateral with the Fed for higher quality collateral, and then it was just kind of like an option, like a handshake agreement. Pay me back when things are better than a year or whatever.
so I ran some of the repo trades back then. We did not do that. So
Okay,
you
that's good
you
to know.
have it
I
on
mean,
good you have good authority on that.
that's why I wanted to talk to you because you were the dude doing the trades, right? So I was like, who else could have answered this question? Because this is a pretty like it's just, I mean, it was a pretty like nuanced thing that not a lot of people would have the answer for that. Who else would have that for the answer than the guy that was doing the trades?
Okay, you're right. So good. I give you a definitive answer. I was there. I did the
Thank you.
trades.
Yeah, because like I asked this question of a bunch of people, and typically the answer is like, oh, it wouldn't work like that. Like they wouldn't do that. But there was like closed door meetings where there was no minutes kept. The Fed was meeting with people, and like we didn't know who they were actually bailing out during 2020. So like, how am I supposed to trust that the Fed is doing the right thing when really the right thing for them is to just prevent the system from collapsing? So we've seen them bail out companies and that should have failed and bail out banks that maybe should have went under in the past. So I just assume the worst when it comes to the Fed. I assume that they're going to bail people out. Like that's their job to prevent the system from collapsing. And I had kind of been hanging on to this one thing about like, well, if there's HQLA and you can have level 2B in these repo markets and the Fed stepping in with hundreds of billions in liquidities with treasuries and base money at the accounts, why wouldn't they just grease the wheels? Why wouldn't they just recapitalize these hedge funds and primary dealers to give them stronger balance sheets to make it through the crisis through the repo markets? But if you're saying they didn't do that, I will let that one go.
Yeah, I actually agree with your overall point that the system is breaking, but I would paint the Fed in a different role, actually. I would paint the Fed as one of the entities that is trying to keep it together, trying to save it from imploding. I think it's imploding because the amount of, basically, so when the U.S. Treasury, when the U.S. government spends something, what they're really doing is that they're printing Treasury securities and buying stuff with it. And Treasury securities, you can think of it as kind of a form of money, right? If you have a $100 bill, that's printed by the U.S. government. $100 worth in Treasuries, you can think of it as money that pays interest. So when you have tremendous amounts of deficit spending, where your money just goes to, basically friends and families and supporters of politicians, then you're just kind of, you know, debasing the currency and giving it to your friends. So that's kind of why I think the system is breaking. The Fed yeah, it's not really the person doing it because they're not really the person one that actually that's making those decisions. They're trying hard to make sure that it doesn't break down, but they're not. I don't think they're the ones breaking the system.
But I see, I can't. I find it hard to sympathize with that argument. I mean, I've heard that a lot, but the Federal Reserve is typically made of people from the banking industry and, the Treasury, and like it seems like it's a revolving door between the central banks, the Treasury, the economists, and the commercial banking system. And with the politicians getting paid like billions of dollars to, speaking fees for these officials, it just doesn't seem to me that separate. It seems like the people that make up these three systems, the Treasury, the commercial bank, and the Federal Reserve, or the central banks in general, they seem to all be from the same cloth.
Well, the people who make the spending decisions, they're the elected members of Congress, not the Fed or the Treasury. So the people who make these huge spending bills, who have all these carve outs and pork that they give to their friends and
Right.
family, these are the people in Congress. These are our supposed elected representatives. These are not Fed people. The Fed people, you know, the they I find them just they're trying to do the right thing. They're not very smart, but they're trying to do the right thing. So I would be worried about more about just the legislative branch more than the others. Although you know uh, the other branches have their problems as well.
I mean, sort of a non sequitur side question, but like when you worked at the Fed, was there any kind of crazy, like, you had to scan a retina or do some kind of crazy futuristic thing to get into the trading office, or like what was it, just like a normal job or what?
No, there's a ton of security. If you ever have a chance, you can go and take a look at the New York Fed. It's in a castle, really. It's at a castle. You got to swipe your ID to get through security and swipe your ID to get out every day. So there's a ton of security there. If you ever give a chance, there's also have one of the largest gold vaults in the nation is in the New York Fed. It's 7 floors beneath the surface.
Oh,
They give
wow.
they
Did you
give you
ever
a
see
gold
it?
yeah, they give you a gold vault tour. Interesting fact, everyone who works there has to wear steel shoes because if you drop a gold block on your foot, you're going to break it.
Oh,
That stuff is
right.
really heavy. But they have tours for the public. Go and yeah, you can check it out. It's pretty cool. So a lot of central banks, foreign central banks, hold their gold in the New York Fed actually. So
Oh, interesting.
mhm.
So, talking about the reserves, right? I wanted to get to this thing. Um, I have discussions all the time with folks, fellow Bitcoiners on Clubhouse and Twitter. Um, Joe Carlasare, I think, is watching right now as well. Is maybe get him to ask a question. He's a Bitcoiner who's a lawyer, and he's studies the banking system and money. And me and him kind of go back and forth about the idea of whether or not Federal Reserve database money. I'm trying to pick my words carefully. Federal Reserve account balances are money. And there's this line of thinking where folks like Steve Van Meter and Jeff Snyder are kind of putting out the idea, or pushing this logic that that's not money. That because when you deposit money in your bank account, the bank will go and swap that for treasuries or something else with the Fed, because they don't want to hold on to the liability of just the money that you deposited. They will go in and swap that. And so Steve Van Meter says, I think it simply is changing the nature and the duration of the money. It's swapping cash for securities or something like that. So are you familiar with that argument with Steve Van Meter?
So there's a lot of people at the Fed. They'll all disagree on many things. Every single one of them will think, yeah, reserves are money. And the same thing, if you ask anybody who works at a big bank, tell you the same thing. And listen, the Fed goes, okay, can the Fed, didn't the Fed go and buy a whole bunch of treasuries, buy a whole bunch of corporate bonds, buy a whole bunch of, no, the Fed buys everything, huh? Yeah, so listen, doesn't the Fed also go and lend in the FX swap market, right? Or lend in the repo market? How can the Fed do that if it can't print money, right? I don't know. So I find that to be very puzzling. I, uh, I don't understand.
I think the argument is because there's a debate about what's causing inflation, and it's two separate arguments in my mind. There's a debate about what is money and what is causing inflation. And a lot of us Bitcoin people, a lot of gold bugs, a lot of Fed watchers and stuff, they've been pushing this narrative that we believe that because the Fed quote unquote prints money, that causes inflation. And the argument that folks like Jeff Snyder are putting out there is that it's actually not the Federal Reserve's printing of bank reserves to do QE that causes inflation. It's supply chain disruptions like
Oh, okay.
COVID and China and
Oh,
stuff like that. That actually causes the CPI inflation. So therefore, bank reserves shouldn't even be considered as money because they're locked inside of the Federal Reserve system in the reverse repo market or earning overnight interest or whatever with the Fed. So they don't make it out into the economy and cause prices to rise. So therefore, we shouldn't even consider that as money. It should just be considered as some other asset like a Treasury or an MBS that doesn't get spent into the economy. I think
okay.
that that's like two separate arguments. I think you can think of Federal Reserve account balances as money, as a form of base money, like M0 base money, but also acknowledge that it doesn't directly cause CPI inflation, but that CPI inflation is caused by something else, but that does contribute to both CPI inflation and asset inflation.
I take your view, and I'll give you a bit more elaboration on that. So, okay, so about I've heard that a lot. Oh, the stuff that sits on the Fed's balance sheet. So, Brad, if you and I, if we both bank at Citibank, right? And let's say I buy $1 million worth of stuff from you, then what I'm doing is that I'm sending you $1 million in my Citibank account to to your account, right? But let's say you and I, let's say in the entire world, only you and I have accounts at Citibank. I have $1 million in my account. You have zero in your account. So when I buy something from you for $1 million, well, I'm giving you $1 million, and you're giving me stuff, right? But if you look at Citibank's balance sheet at the end of the day, it's just $1 million in deposits, right? And maybe you take that $1 million I give you, and tomorrow you buy something back from me. It's moving around, but at the end of the day, there's only $1 million on deposit at Citibank, but it's moving all the time, right? So it's the same thing at the Fed. It's like a whole bunch of people have deposits at the Fed. At the end of the day, there's only so much money, but it's moving around all the time. So it's not useful to look at. I mean, what does it even mean for it to slash around? It can only stay on the Fed's balance sheet. So it's similar to this example that I just spoke with you about if we had deposits at Citibank. So I think what people are missing about quantitative easing is that the Fed creates a whole bunch of money and it buys something. What exactly is it buying? The key to understanding the effects of QE is to see that when the Fed is printing money and buying treasuries, it's kind of taking one form of money and swapping it with another. It's in the financial system. If I give you $1 million worth of treasury securities, it's kind of like giving you $1 million bill that pays interest. If you don't want that $1 million treasuries bill, you can easily just liquidate it like that. You can get $1 million. It's super liquid. It's risk free. It's fungible with a whole bunch of with basically a pile of cash. So it's you're basically buying $50 bills, like 250s with 100, something like that. So not exactly, because there are some frictions, but it's very comparable to that, and which is why when the Fed does QE, it's printing money, but you're also taking out another form of money. What's really inflationary then is the creation of treasury securities to begin with, and that has to do with deficit spending, which is what I believe is the true driver of all the inflation that we've seen the past 2 years. The US government has just printed and spent tremendous amounts of money and used it to buy stuff. Yeah.
Okay, so yeah, that's kind of like a nuanced take. There's two things there where you said that when the Federal Reserve does these actions in the market, whether I guess it's through QE or um, the Fed traders doing like trying to set interest rates through buying and selling at the FOMC, or if the FOMC tries to set the rates, and then the Fed traders go and try to sell or buy securities, or they used to more so do that right before the
Yeah,
Fed got into the repo market.
no more QE anymore. We're doing QT now.
So when the Fed is doing the QE, it's swapping one asset for another asset, treasuries for base money, I guess.
Yep.
Federal
Yep.
Reserve account tokens.
Okay.
So nothing new has been created in that scenario, right? Or when the Federal Reserve, because in your book you say
So
that
okay, let's say that you're a bank, okay? You have treasuries on your balance sheet. Okay, let's say I'm the Fed and I buy it from you. Okay? At the end of the day, let's say you have $100 fewer in treasuries and $100 more in your account at the Fed. Poof, $100 more reserves, basically. Okay, 100 more Fed tokens. That's how it is. That was created by the Fed. But at the same time, you lost $100 in treasuries. Now, if you're a big bank, it's not really going to change your position very much, right? Instead of having treasuries, you have deposits at the Fed. They're comparable assets, but the action of the Fed going out and buying this pushes up the prices of those treasury securities, which in turn pushes down yields, which is the whole purpose of QE, to push down yields.
is there scenarios where in that example that you just gave me, and this stuff is confusing. So I mean, I'm even confused about what you just said about that the math or the accounting on that. So you're the Fed guy, I'm the bank. You're buying 100 treasuries from me. You're giving me bank reserves
Well,
balance at my Federal Reserve account,
yep,
and you
and
get the treasury.
yep,
You get the
yep,
treasuries. So
yep.
now there's two things. Like the Fed created $100 worth of base money in the
Yep.
Federal Reserve account, in my account, and it has the treasury. So
Um,
isn't that act
yes, but
creating?
the Fed owes you $100. It's a liability for the Fed. The Fed owes you. You own the $100 in Fed tokens. It's on deposit at the Fed, which the Fed owes you. So the Fed assets 100 in treasuries, liabilities 100 in Fed tokens to you, to your bank.
In that scenario, that doesn't really create new money. It just creates new liabilities that might eventually be money.
So if you're a bank, you know, tokens at the Fed is money. I mean, well, so for you and I, we have a deposit at a bank, right? That's money to me. What I see in my checking account. Now, if you're a bank, where do you put your money? You put it at the Fed. So that's money for banks. So
Okay, so if you own, like, if you're the Fed and you've created this $100 of base money that is in my account that is a liability, does that ever move from the liability column?
no, it's always a liability of the Fed.
Like, can
So
that make it outside of the Fed's database somehow? I know that there is a way that the banks can actually request physical cash, and
yeah,
then that would debit from
yeah,
the
that's a
liability side.
yeah,
But
that could happen. Yeah, but
this Fed
oh,
money, that's sort of there's 4 trillion of this money, this base money, but not a lot of that comes out as physical cash, right?
we don't. Well, okay. So going back to that example where me and you both banked at Citibank, and I sent you $1 million in bank deposits, right? So that money, it's if you look at Citibank, it's always sitting in Citibank, it's just moving from one account to another, right? But at the end of the day, I bought something from you and just moved from my account at Citibank to your account at Citibank. It's the same thing for deposits at the Fed. Maybe JP Morgan sends Wells Fargo something. So then that money moves from JPM's account at the Fed to Wells Fargo's account at the Fed. At the end of the day, the total amount doesn't change, but it's moving around all the time.
Yeah, I mean, it from your book and from other books I've read, and it does seem like the supply of different forms of money has been increasing, both by commercial banks creating
So
commercial bank money and by the Federal Reserve creating base money
okay, so
through QE.
I used a really simple example in for QE in terms of so Fed buying from a bank. So it's a little bit more complicated if the Fed buys from an investor, because an
Like a
investor
hedge
does,
fund?
yeah, because hedge fund does not have an account at the Fed. Okay, so let's say I'm the Fed and you are the hedge fund. So Brad, you sell me $100 in treasuries. Okay, now I'm the Fed. I have $100 in treasuries, and how do I pay for that? I print reserves. Okay, so I said I print $100 in reserves, and I send it to you, Brad. But here's the thing: you don't have an account at the Fed, so how am I going to give you your money? What happens is that I give $100 in reserves to your bank. Let's say you bank with Citibank. Then at the end of the day, Citibank is going to have $100 more in reserves because I'm the Fed. I sent it to your bank. Okay, your bank receives $100 in reserves, and I say, and it knows that it's because of the transaction to you. So in your account at Citibank, it adds $100. So Brad's checking account gets $100 bigger. That's a liability on the bank. And Citibank owns $100 more on deposit at the Fed. So in that sense, it expands the amount of deposits, M2, in the system. When
So that created new
bank
M0 and M2.
exactly. So, but listen, same. Okay, so you're sometimes you're freezing a bit, so I don't know if you're hearing me. Um, so,
I hear you.
hello? Okay, so if I send you, so in this case, you have a treasury from your perspective. Now you, rather than having $100 in treasuries, you have $100 in deposits at Citibank. Is that really, do you really have more money? I don't think so. I mean, $100 in treasuries, it's very comparable to $100 in bank deposits. So you can, in that sense, the money supply is not really changing. You're just swapping one form of money to another. And so even if you do this at a very large scale, you're not necessarily creating an inflation. It's not inflationary, right? Because it's not that the quantity of money changes, but the composition of money. Fewer treasuries, more bank deposits. Uh,
So it is kind of it's a little bit of a semantics argument then to say that the Federal Reserve account balances are not money, but it's kind of like a consensus thing. I guess we're gonna get there in the next 5 to 10 years. People will figure out whether or not this stuff is money. I lean towards
so I want to be very clear with you about this. People who say it's not money, very small group on Twitter, not in real life. Okay, if you are in real life, nobody, listen, from the biggest bank to the smallest bank will be like, "What are you talking about?" Okay, so I just want to be clear about you.
okay. So so it's fair then to say that in the QE paradigm, the money the Federal Reserve account balances that is created is a form of money.
Absolutely, 100%. Dude, if you go into the people who work in this field, either at a central bank or a commercial bank, or people who study this, and no one will ever take issue with that. It's
But
actually
but
really strange to me that people actually would say something to the contrary.
On the other side of it, it is also accurate to say that that form of money that's being created by QE is not directly causing inflation and CPI.
That's my personal view, and that's based on what I understand. Um,
Okay. So
it
that I
does
think that's
it
a
does
that's a nuanced kind of concession that like Bitcoiners typically we think the Federal Reserve prints money and it causes inflation. And when people say that the Federal Reserve is doing quantitative easing, it's not actually causing inflation. We kind of like yes it is. So I think
it,
we should acknowledge that the Federal Reserve printing base money is not causing CPI inflation. But the what do you think about the other argument that the Federal Reserve, by keeping rates low, and the Treasury and Congress by doing tons of stimulus, and the commercial banks by doing lots of lending, causes asset inflation and CPI inflation?
100% agree with all that. So QE, causes asset price inflation, right? You know what? That's the whole purpose of QE. Okay, not the whole purpose, but part of the purpose of QE. QE is meant to lower interest rates, create wealth effect. So listen, if you're the Fed and your goal is full employment and stable prices, but okay, the problem is that prices are low, inflation is low, and growth is slow. So what do? Well, you know what? I'm going to make people richer. I'm going to make their stock portfolios go higher. I'm going to make their home prices go higher. So maybe they look at this and they go and spend more money in the real economy. How do I do this? Lower interest rates. So that's kind of what QE does. There are other aspects of it, portfolio rebalancing and so forth, but that's kind of a key channel. So that's one thing. But if you can accept the idea that treasuries are a form of money, then you would see that when you have significant deficit spending, that's when you have real money printing, where you print money and you buy goods
Right.
and services. And so that's what the US did to a remarkable scale the past 2 years, and we have inflation. And it's actually, if you understand um, this aspect of it, it was a very easy call.
In your book too, you also say that like regarding this QE stuff and the creation of central bank reserves in the system, you say that the academic models, and this was in 2020 that you wrote this, or maybe you wrote it in 2019, but I think it was published in 2020.
Yep.
So academic models suggest that QE is effective in lowering interest rates and does help boost inflation. But however, you said the experience of the Fed, the BOJ, and the ECB all show that massive QE, at least by itself, is not enough to sustainably move inflation higher.
Yep.
You wrote that before the CPI inflation rose. Did you reconcile that with your
Oh,
thoughts, or you think
no,
it's still
it's
accurate?
it's still accurate. Fiscal spending, like I mentioned, fiscal spending is what makes the difference. So listen, QE doesn't boost CPI. That's obvious, right? Bank of Japan has been doing this for many years. Fed has been doing this for 10 years, right? But what happened? What's changed in the past 2 years? Massive fiscal spending, right? QEs, we're still doing, we still did QE. We've been doing QE for almost a decade before any CPI inflation showed up. So I don't feel that is anything has changed. But there actually is a
So Joe Carlos says QE always raises interest rates. Every time QE starts, the long end yields rise. We can see it empirically. Um,
so
what are your thoughts on that idea?
I would push back against that. So so the Fed buys $5 trillion in Treasury securities. How can that make interest rates go higher, right? So you're buying a lot of stuff, the prices go higher, right? So what I think of it as is that there's another aspect to this as well. When the Fed buys stuff in the markets, when the Fed is doing QE, it's usually when the world is breaking, like March 2020. At that time, interest rates are super low because everyone is depressed, right? So Fed comes in and saves the day. So people feel like the world is not ending. So there's that aspect as well, right? So when the Fed starts buying, it's usually when things are really bad, not just March 2020, but during the GFC as well. So you have to keep that in mind as well. So many things determine interest rates. I think fundamentally it's supply and demand. And if you have a lot more supply, and in the Fed's case, they bought a lot, I think that it's logical to think that has upward pressure on prices, which is to say downward pressure on yields.
So okay, so Joe also says then if the whole purpose of QE is to lower yield,
Right, right. That's what I just mentioned.
and it's because you said that there's a supply and demand
Okay, so listen.
imbalance when
No,
QE
no, no.
starts.
So listen, when did Fed do QE in March in March 2020, right? World's about to end. Everyone is rushing into treasuries because the world is about to end, right? Okay. Well, Fed comes in, saves the day. World is not about to end. Things can go higher. Everyone, gets out. So there's that huge risk off trade that came off, right? But for me, it's hard to understand how you can how buying $5 trillion of something does not push the price up higher compared to if you did not buy $5 trillion worth of something. So I mean, I don't see how you could reconcile that.
Well, I'm not smart enough to debate that one with you, so maybe we'll get you and Joe talking sometime. I did wanna go to, like we'll go to, like, the bond market sort of like but at the balance sheet level, I'm curious on the bookkeeping, like, part of this, like, let's talk 101 for bonds for a second. What actually happens on the accounting side of things when a bond matures?
um, when the Fed buys a bond and it matures.
So, like, when let's say I have $1 million worth of bonds that are
Yep.
maturing, and well, let's say we'll start from when they get issued so that I can buy them. So the Treasury has an account at the Fed called the Treasury General Account, right?
Yep.
And that is like kind of a similar database. It's the same database as what the banks have. The banks have these accounts too, but not Treasury General accounts. They just have regular accounts.
Yep. Yep.
So the Treasury spends from that account when bonds mature? Do they
Yep.
send from
Yep.
that account?
They do.
So let's say the Treasury is issuing $1 million worth of bonds. Um, what's the accounting like to that? And I'm buying them. Like, what is
Sure.
that? What works? How does that work on the?
So what happens is that, so you send a payment to the U.S. Treasury, right? So let's say again, you bank at Citibank. I just say Citibank because that's my bank. So you have $1 million in Citibank and you send it to the U.S. Treasury. What happens is that the Citibank sends 1
But
million.
so wait, I send it to the Treasury, and how do I do that? Like, is there
Yep, yep.
some
Uh, uh,
website or
uh,
something that I
uh,
can
uh,
go and say, I want to buy $1 million of bonds?
okay.
Like, how would a person buy bonds? How does that actually work?
So you can go to your Treasury Direct on the Treasury's website and actually do that. In practice, people just buy it through ETFs. But
Okay,
what you would do is you would just send it, and what happens is that Citibank sends $1 million to the U.S. tre- to the U.S. to the TGA basically. And on the books of the Fed, what it looks like is Citibank minus $1 million in deposits at the Fed, TGA plus $1 million in
I see.
deposits at the Fed,
So it's
and
not commercial bank layer money then that the Citibank is
no.
sending. I'm sending commercial bank layer money to Citibank.
Citibank creates the commercial bank layer money. So the Citibank, so your deposits at Citibank go to zero. So on the liability side, oh, can you? It's the
Yep. You
thing
said
seems
the
to be frozen.
deposits, my
Okay.
deposits at the Citibank go to 0 because I'm buying the $1 million of treasuries.
Yep. And then Citibank has, on the asset side, Citibank sends $1 million in deposits. It held at the Fed to the TGA, and so the TGA is $1 million higher. So
So
on the
so $1 million got deleted from the commercial banking
Yep.
system,
Yep.
and $1 million of base money gets sent from, a Federal Reserve account by Citibank to the Treasury General account.
Which is also on the at the
Which
Fed, right? So
right.
at the end of the day, if you're just looking at the Fed's balance sheet, it hasn't changed. It's just money deposits moved from the Citibank's account to the TGA account.
And then the Treasury creates a bond,
Yep,
$1 million worth of bonds.
yep.
Is that also like a token on the Federal Reserve's database? Like, how is that accounted
Actually,
for?
actually, it is. It's not like a token in the blockchain sense, but it is a book. It's a book entry at the Federal Reserve. So every treasury security. So back in the old days, there actually was a paper treasury security. These days, it's just a database entry in the database at the Federal Reserve. So the Federal Reserve would be like, Treasury to Brad. So can you?
Account numbers tagged? I'm
I'm sorry.
owed this. I have this.
Uh, I missed the part. The connection it seems to be breaking a bit. What?
Oh, sorry. So when the Treasury creates that, the Federal Reserve is keeping track of the both?
So
What
things seems to be breaking up, but yeah. So when the Treasury creates it, the Fed's jobs, the Fed does many things. One of its jobs is to be the banker for the U.S. Treasury. So when the U.S. Treasury issues debt, it's the Fed's job to manage the database of you know who owns the debt.
So, okay, fast forward 2 years. Let's say it's a 2-year bond. It matures. What happens in that situation?
So in that situation, the reverse happens. The TGA, okay, the TGA has, let's say, sends $1 million to your bank. So let's say the TGA again, same transaction, TGA minus $1 million sends it to Citibank's account at the Fed. Citibank then has $1 million more in its on deposit at the Fed, and then it credits your checking account with $1 million. So it's just the same thing, just in reverse.
So $1 million is then created in the commercial banking layer.
Yes, exactly, exactly.
Okay.
Okay, so yeah, there's actually a really easy way to illustrate this. If you look at the total deposits in the banking system, this past the past 2 months, it's actually declined. And why is that? It's because of tax payments. People sent money to the TGA to pay their taxes. They sent hundreds of billions of dollars, and so money is deleted out of the commercial banking layer of the system. Yeah.
Do you know the size of the TGA account right now, roughly?
I think it's about 700 million, about billion, 800 billion
Okay.
dollars.
So thank you for explaining that. Now, the bigger question I have around how this works is I don't understand how the next 2 years is going to play out safely because right now there's $30 trillion of U.S. Treasury debt, and the Federal Reserve, through the Federal Reserve's QE and the repo market operations in 2019 and 2020, they've acquired $5 trillion of treasuries, and intergovernmental holdings like Social Security and others like I think I can't remember the other names, but they have $6.4 trillion or so of U.S. Treasury. So around $11 trillion of the 30 trillion is held by basically like government or arm's length government entities in the Fed. And as they mature, the Treasury pays the holders. So if and I looked at this with kind of seeing like how it's structured over the next 5-10 years, and it seems like there's this massive amount of debt that's going to mature. There's $9 trillion of debt that's going to mature over the next 2 years. And the Treasury is going to have, because we don't have the tax receipts, the US doesn't have the tax revenue to be able to pay that in the Treasury General account to be able to pay the bondholders when they mature. So they're going to have to create more debt to finance paying off the old debt. But I know that there's strong demand from individual investors currently in the bond market, and there's strong demand in the bond market from banks and stuff. But it's hundreds of billions of dollars. It's not trillions of dollars right now. So who is going to buy that $9 trillion worth of new debt that's going to have to be issued by the Treasury? And like, wouldn't it have to be the Federal Reserve to buy the bulk of that new debt?
So that's actually a very valid concern. So the market is always changing, and so who the marginal buyer of debt is also always changing. So before 2020, like I suggested, it was the hedge fund community. Post 2020, it was the commercial banks and the Fed. Afterwards, it's hard to see who's going to be the marginal buyer of debt. But here's the thing, though. Let's say the market does eventually break or something like that. At the end of the day, the Fed can always buy it all. It's already shown that is willing to. So I don't really worry about that aspect of it. Yes, the market could crash very severely, but the reaction to that would also be swift. Fed would come in and buy it all. So I think the bigger question is, what are the implications if, basically Treasury keeps spending and the Fed just keeps financing it? And I think that the bigger picture implications are a world that is structurally higher, structurally more inflationary, simply because, Congress has a spending problem, as I've suggested many times. So I don't really worry about being able to finance that debt because at the end of the day, Fed will do it all. And if Jay Powell won't, I'm sure they'll get a Fed chair that will.
So in that scenario where there's 9 trillion maturing and the Treasury has to pay the Fed, but then the Fed just prints the money to give to in the Treasury general account, and then it
Yep.
gets sent back to the Fed. Isn't that like a Ponzi scheme? Isn't is that kind of a little bit crazy that's how it would work?
So listen, the U.S. Treasury borrows money, and how does it pay the people who lent them money? It borrows from other people, right? So it goes on and on and on. It is exactly a Ponzi scheme, no doubt about it.
So it's not just kind of like a Ponzi scheme. So I was asking like Bitcoin Tina is this guy on Clubhouse and Twitter that he's a real smart guy, and he got mad at me because I said, "Isn't it, if why wouldn't the Treasury just or what since the Fed owns all the debt, why wouldn't they just cancel it if they're going to roll off the balance sheet? Why wouldn't they just do away with the theatrics
No, no,
and just
that's kind
cancel the
of,
debt?" And he's like, that would mean the default of the US government. They would never do that. So I mean, I guess I understand that perspective that they want to keep up the appearance even though it is like a bit circular Ponzi-esque.
So if you have, listen, when you're doing QE forever, you're basically canceling the debt. So listen, let's say you're the U.S. Treasury, right? And you borrowed money from the Fed, right? Okay, so you issue treasuries, and I'm the Fed, and I bought it, right? Okay, great. Let's say 10 years go by. Um, okay, you got to pay me back. So you pay me back. How do you pay me back? You issue new money. Well, actually, no. So and then I just lend it back to you, right? It's you never have to pay me back because you pay me back with money that I lend you. So you just kind of it's basically canceled because you never really have to pay you back since when you pay me back, I just lend it back right back to you, right? So it's kind of canceled in the sense.
Yeah, it does kind of seem a little bit like
If I'm
theatrical.
if the Fed is always just reinvesting its money, then whenever the Treasury pays the Fed back, the Fed lends it right back to the Treasury. The debt is essentially canceled. So functionally, that's what happens. You don't say that, but functionally, that's what happens.
Well, listen, we've been going for like 2 hours. I have so many more questions. Honestly, maybe we can do a round 2 sometime. We didn't even get into the Eurodollar system or the shadow banking system. I have like a lot more questions. Um, I appreciate you coming and taking this time to talk to me, and hopefully, yeah, get you talking to some of the other Bitcoin folks. Lastly, I just wanted to ask you a question on Bitcoin, just to hear your thoughts on it, because I think I heard you recently on a podcast. I forget which podcast it was, but you were kind of thinking that the idea of like cryptocurrency wouldn't work as money because governments would kind of turn against cryptocurrency. And Eric Townsend is like Macro Voices, hedge fund manager guy. He likes to kind of push that narrative that like there's central CBDCs and there will never be a decentralized currency like Bitcoin that would work for a world reserve asset that banks would use and stuff. More so that it would be like a centralized digital currency layer that the banks run. Um, I wonder, have you given much thought, Joseph, into the mechanics of Bitcoin specifically? And do you separate Bitcoin from cryptocurrencies in your mind, or do you look at like DeFi, Ethereum, Bitcoin as kind of all one sort of similar asset class?
So no, I recognize that Bitcoin is like the marquee crypto. It has much more recognition, much wider support than the others. So there's a lot of ways to approach this. So like I mentioned earlier, even if you use Bitcoin as some kind of reserve asset, you run the problem of, it's not so much reserve asset as the people who manage the system who can cause trouble. We were on the gold standard before and we got off it, remember? So that's one aspect of it. I think there's some serious concerns from my perspective about what the government will do to try to fight alternative currencies if they become very powerful. We see that already playing out in places like China, right? This government says I don't like it, it's gone, and I think that's a very serious risk that we have to keep in mind. I think it's a dream to have a sort of value independent of the political system of the government. Very important. I don't know how we can go about doing that. So I sympathize with the I sympathize with the movement in trying to find something like that. So it could be Bitcoin. I don't know.
Have you ever looked? Have you ever looked into like what makes Bitcoin specifically resistant to things like government clampdowns and bans and things like that versus the other cryptocurrencies like DeFi and Ethereum?
I am not aware of that.
Would you be interested in like watching a video or two or reading if
Yeah,
I sent you
sure.
some books?
Yeah, send me some stuff. Happy to learn. So listen, I appreciate you inviting me. Happy to chat about, the TradFi system, as you guys call it. So, happy to chat about this stuff. And glad to be able to help you and your audience learn more about it. And
Yeah, I appreciate
I
that because
appreciate.
there's a lot of misconceptions out there about how the system works, and it's great when we have people like you that actually work in the system and know it really well to be able to explain it to us.
Yeah.
I just say, yeah, it would be good to swap info because Bitcoin is resistant to governments. The things that they can do is clamp down on the exchanges, and they can make laws like the Executive Order 6102 that banned gold ownership. 50% of people actually kept their gold because they didn't have it in a bank. So that's why Bitcoiners typically are like, hold your own keys, run a node, because then even if they do
Not your
ban it,
keys, not your coins, right?
yeah, exactly. Not your keys, not your cheese. So Bitcoin has the largest amount of like sovereign holders, so that even if they did try to ban Bitcoin, I think it's too late. I don't think it's too late for them to ban other cryptocurrencies because none of them are as decentralized as Bitcoin, and they wouldn't stand up to like a 6102 style attack on uh on these private currencies. But Bitcoin actually does have the ability, because it's so decentralized, to resist
Hmm.
government. They couldn't enforce it. Basically, they could stop you from easily getting out through exchanges, and just like they've made downloading movies and pirating movies illegal on BitTorrent, but yet millions of people still do it. It's impossible to enforce a ban of something like Bitcoin, but you can they could affect the price of Bitcoin in the short to medium term by clamping down on Bitcoin and making it like illegal to use Bitcoin or mine Bitcoin. But even in China, we see that there's been a resurgence of Bitcoin mining where it's illegal to mine Bitcoin and use Bitcoin in China, but now it's kind of back up to about 15-20% of the global hash rate is in China. So you see people just like in the United States when they banned gold ownership, people just waited it out. They just kept their gold and they held on to it. I think you'd see the same thing with Bitcoin, even if we get into that like apocalyptic scenario where governments really turn against it.
Oh, I'll
But
take a look at
that's
the
another
materials you send me.
conversation.
Yeah, I'll take a look at the stuff you send me.
All right, I appreciate it. Thanks very much. And so how can people find you and your book?
Yeah, so I'm on Twitter at FedGuy12, and also I have a website, FedGuy.com. And if you're interested in learning more about the TradFi space, you can take a look at my book, Central Banking 101. It's on Amazon, and
And
also
it's
available in Portuguese and soon in Mandarin Chinese as well.
El Gosta Portuguese. All right, thanks, Joseph.
Thanks, Brad.